Hi, are you self-employed or running your business while working tirelessly, also at your day job? Maybe you are at the starting point of your next big adventure. Either way, to grow your business, you need to have a sound business plan and a great tax strategy. One way to achieve both goals is to start an S corporation. In the next 5 minutes, I want to show you why and how to do it. Let's first understand the benefit of having an S Corp. The first advantage is pass-through taxation. Owners report their share of profits and losses on their individual tax returns. So there is no double taxation on income as a C Corp. And the second benefit is that of limited liability. Company directors, officers, shareholders, and employees enjoy limited liability protection. No one likes to be sued. This is a must-have for any small business owner. A third benefit is the possibility of turning this S corporation into investment opportunities. You can attract investors by offering the company's stock for sale. This means liquidity and more opportunity to grow. A fourth benefit would be a simpler tax filing requirement. The S corporation only needs to file a corporate tax return once a year versus C corps, which must file quarterly. And the last major benefit is its tax advantages. Did you know the S corporation owner can write off startup cost against personal income in early years? And an S corporation could have reduced taxable gains when the business is sold. But there are some disadvantages you must be aware of also. Number one, it offers only one class of stock. This means it is less attractive to outside investors. Number two is more tax filing requirements than filing as a sole proprietor. You must file a corporate tax return once a year. Thirdly, it's corporate meeting requirements. You need to have regular meetings and maintain company minutes. Now, let's see, what are the alternatives to an S corporation? The first one we want to talk about is a limited liability company, otherwise known as LLC. Many states allow for the protection of limited liability company member shares from being attached in personal actions taken against the members. Why is this good? If you're sued personally, any shares you own in a C or S corporation can be seized if you lose the lawsuit. Flexible choices on tax filing. If you're a single member LLC that wants to be taxed as a sole proprietorship, you don't have to notify the IRS of your plans. Just file a Schedule C with your Form 1040 at year end. A second alternative is the sole proprietorship using a DBA as Schedule C business. Plain and simple, but you must pay 15.25% self-employment tax on your entire net income. A third alternative is to incorporate as a C corporation. The major problem, though, with a C corporation is double taxation. You must pay income tax before the distribution of profits to shareholders, who have to have income tax again, versus an S corporation, the income passes through to the owner and the owner only pays income tax once. Now, let's discuss if the S corporation's owner needs to pay Social Security and Medicare tax. The S corporation income is reported to the IRS on a K-1 form. It is subject to income tax, but not Social Security nor Medicare tax. But that doesn't mean the owner is exempt from paying the so-called self-employment tax, currently at 15.25%. It means if the owner of the S corporation worked for the corporation, the owner should be paid a reasonable salary, and only the salary portion is subject to Social Security and Medicare tax. Let me illustrate with this chart. If a S corporation has net income of $100,000 in a year, under the sole proprietorship filing under 1040 Schedule C, the owner will need to pay 15.25% self-employment tax on the entire $100,000. But with the S corporation, the owner may only need to pay Social Security tax on $40,000 a year salary if the $40,000 is deemed to be a reasonable salary for his service. In this case, the savings would be $9,150 in tax. If you have any questions, feel free to visit my site. That's cpacia.com.